Welcome to this video on the option Greeks, a mysterious component that determines the price of option contracts. The option Greeks are made up of delta, gamma, theta, vega, and rho. Each one of these has its own unique characteristic, a characteristic that changes the price of the premium of your option contracts. Let's break them down one by one to understand the role each of them plays in the options world. Delta is your direction Greek. It indicates how much the option value will change for every $1 increase in the underlying asset. This means if you own a call contract and the stock price increases $1, then your call contract will increase by the amount of delta it has. Let's take a look at an example. Let's say that the delta is 0.3, and let's say that the stock moves up $1. In this instance, a call option will increase 30 cents in value per contract. That means if the premium is $5 and the stock price moves up $1, the new premium will now be $5.30. Delta is higher for options that are in the money and lower for options that are out of the money. For this reason, delta tends to be used as a profit probability calculator. For instance, the higher the delta, the higher the probability that the option will be in the money at expiration. Call deltas range from 0 to 1, while put deltas range from -1 to 0. Our next option Greek is gamma, the acceleration. Gamma measures the rate of change of delta with respect to changes in the underlying asset's price, meaning how fast delta changes as the stock price moves. For instance, if an option has a gamma of 0.1, the delta will change by 0.1 for every $1 move in the stock's price. This is why delta changes and never stays the same. We have gamma pressing on the accelerator to change the delta amount. Let's take a look at an example. We'll stick to the previous example with a delta of 0.3. As you'll remember, as the stock moves up $1, the call option will increase 30 cents in value. If we have a premium of $5 and the stock price moves up $1, the new premium is now $5.30. But let's add gamma to the mix. In this scenario, gamma is 0.1. So for every $1 increase in the stock price, this will change delta by 0.1. So if the stock price increases $1, delta will change to 0.4. The next time the stock rises $1, the option will increase 40 cents in value. Basing off of the previous example where the stock price moved up and the premium moved from $5 to $5.30, if the stock moves up another $1, the new premium will now be $5.70 because the delta has changed from 0.3 to 0.4. Theta is your time decay. Theta will estimate how much the premium will decrease as each day passes. Since options lose value over time, theta will always be negative. The amount of theta will increase as contracts get closer to expiration. This causes the option prices to fall more rapidly. Let's take a look at an example. A call option contract expiring in 4 weeks. On day 1, it has a premium of $2. The theta on this day is -0.09, meaning that as each day passes, this premium will decrease by 9 cents. If the underlying asset does not move and nothing else changes, then on day 2, the premium will be $1.91. As previously mentioned, theta increases as contracts get closer to expiration. So now, let's look at the same call option strike price, but expiring in 4 days. On the first day, the premium will be $2. Theta, however, is now -0.3. This means that if nothing else changes in the underlying asset, on day 2, the premium will be $1.70, a decrease by 30 cents. Take note that this only affects the extrinsic value of a contract. Vega is our volatility Greek. Vega measures the sensitivity of an option's price to changes in implied volatility. It shows how much an option's price will change for a 1% change in IV. Implied volatility, or IV, is how much the market thinks an asset's price will change in the future. It's an estimation of future price movements. We can compare this to the weather forecast. Let's take a look at an example. Let's say we have a Vega of 0.2 and a call option premium price of $5. If the implied volatility, or IV, increases by 1%, the call price will increase by 20 cents. Our new call option premium price will be $5.20. If the IV decreases by 1%, the call price will decrease by 20 cents. The new call option premium price will be $4.80. Vega will be higher when IV is higher. This is something you will see when there is a catalyst like earnings season. And just like theta, Vega only affects the extrinsic value of an option contract. Rho is our interest Greek. Rho measures the sensitivity of an option's price to changes in interest rates. While not typically used by day traders, Rho is still a Greek to take note of. A positive Rho means that the price will increase as interest rates rise, whereas a negative Rho means that the price will decrease as interest rates rise. For every 1% increase in interest rates, the option price will increase by the Rho value. Let's take a look at an example. Let's say the call option premium price is $50, and the current interest rate is 4%. In this scenario, Rho is positive 0.03. So if the interest rate rises from 4% to 5%, or in other words, an increase by 1%, the new premium will change from $50 to $50.03. However, in this scenario, if the interest rate falls from 4% to 3%, or in other words, a decrease by 1%, the new option contract premium will change from $50 to $49.97. And just like theta and vega, Rho only affects extrinsic value. We've now discussed the 5 option Greeks: delta, gamma, theta, vega, and Rho. Keep in mind that option pricing changes due to all of the Greeks. Therefore, we can never single out just one Greek to estimate how a contract will change. We must keep in mind that all of these are working in a cohesive way, causing the premium price to rise and fall. You should now have a better understanding of how the option Greeks work and how you may be able to implement them into your strategy going forward.